Everyone. So remember our last video, we explained what it means to own an option and what that actually entails. Now, a couple days in the market have gone by, and we're going to look at a couple of the options we highlighted in the last video and see how they performed this week after 3 trading days and try and understand why. The thing I like most about this is since options are so exciting, you know, the lure of making a lot of money, but actually if you look at the Apple strikes we used from last week, all they did was go down. So this is a good lesson for people to understand right off the bat that you can lose money on options too. And a lot of it very, very quickly if you're not careful. So if you recall, we were looking at the right to own Apple stock on October 12th at 670. So the 670 call strike was trading at $4 on Friday's close, October 5th. Today is Wednesday, so we've had 3 full trading days, and that same price, the premium price, closed at 12 cents today. You can see here it closed at 12 cents. So it's down 94.5% from Friday, even though Apple's only down less than 2% on the week. Okay. Now, why did this happen? How can the premium drop 94.5% even though the stock only dropped 2% so far? Well, remember what we said about how greater uncertainty generally translate to greater premium paid. If you put it in this context, remember Friday's close around 652 on the stock, there was greater uncertainty as to where Apple would be 5 trading days later at that time. Okay, and as a result, the right to own Apple at 670, remember that's the premium we purchased, or you could have purchased for $4 on Friday. It demanded a higher premium. But now 3 days have gone by. We're only 2 days away from Friday, the expiration date. The premium is only 12 cents because there is near clear certainty that Apple won't be above 670 by week's end. Okay? So 5 trading days away from the expiration date, there was greater uncertainty as to where Apple would be, and that demanded greater premium to be paid. Now Apple is trading around 640, and there is pretty clear certainty that Apple won't be above 670 by week's end. Otherwise, it would have to make a 30-point move right here in a matter of 2 days, or 4.5%. That would be a big move for Apple. So if you ask this question to understand why the premium went down so much, put it like this. Why would you buy the right to own something at $670 by week's end when you can apparently just wait those 2 days and buy it for cheaper? In other words, why would you buy the right to own Apple at $670? Why would you want to own the right to that when someone can just go out on the market likely at this time on Friday and buy it for less than $670? You wouldn't. Say Apple even rallies 30 points. It makes, 20 points back up to 660. So it makes a 3% move, which is still a big move in 2 days. Say it does that. Still, 660 looks a lot better to just buy it on the market than wanting to own the right to own it at 670 when it's expiring in a day. Because once you pass expiration, you no longer own the right to anything. It's like an expired driver's license. You can drive the car, but if you get pulled over, your license is still expired. Okay? So, Apple below 670. Apple obviously below 670. If that's what the market's thinking, there's not going to be a lot of premium demanded there. So this is this is what happens. It closes at 12 cents. Now, also what's important to note is that on Monday, Apple gapped down from a 652.58 Friday close to open at 646.66. Okay? You can see this here on the 30-minute chart. Here's Friday where Apple closed, and then here's the open. High volume. Look at that. High volume at the open on the down move, on the gap down. So even more bearish. So this translated to a $2.88 open for the premium on the 670 strike call from a $4 close. In other words, this gap down of less than 1% in Apple resulted in a 28% gap down in premium price overnight. Why? Well, think back to that basketball player analogy we used in our first video. Remember how we needed him to, how it was a good sign if he scored 10 points in the first quarter, we could feel more certain about betting that he would end the game with 20 or more. But if he didn't score any points, now it's harder to be certain he'll end up with more than 20 points, okay, if he doesn't score any through the first quarter. Well, Apple didn't score any points in the first quarter. It had a terrible start to the first quarter. It gapped down, okay? This resulted in a big hit to the premium. So this example shows that premium can prove worthless over time as greater certainty overtakes the marketplace and it becomes clear the right to which you own is no longer valuable. Like in this example, the right to own Apple at 670 come Friday's close is no longer valuable. It doesn't look attractive based on the fact that we're 2 days away and Apple is only at $640. It's like we're 3/4 through the game and the basketball player still only has 6 points or something. It's just not going to be an attractive bet. It's going to be a high risk type bet, or and that's why it'll be cheap. 12 cents. It's not a very attractive bet, so the premium that it demands is very low, 12 cents. But if you owned it on Monday, you got slaughtered. Okay, so that's that with that option strike. Now remember the other premium we talked about. The right to own Apple stock on November 17th at $700 per share was trading at a price of $12.30 on Friday's close when Apple was around $6.52. That premium has since fallen to $8.10, or 34%, again, while Apple is only down 1.8% on the week. You can see this here. With this down move. Okay? Now, there is a difference, though. On that same gap down, this premium gap down 13% versus 28% in the other premium. So yes, it's better, but that's still not really good at all. This brings us to a very key ingredient on successful option trading. Knowing when to take a gap down loss. What do I mean by that? When a stock gaps down, your option is going to gap down, the premium is going to gap down. You need to know when to get out of that. Because this 13% loss has now turned into a 34% loss if you were in this and you did not sell. Okay? And again, this speaks to something more fundamental as a trader, and that is your preparation, which I talk about in a lot of videos. Prep and planning for multiple expectations. So for instance, coming into this week, one needed to be prepared for a hard break below 650 on Apple and use it as one of their criteria for a stop loss. If you were coming into this week and you were trading Apple, and I were to ask you, okay, what's your stop loss? You can have multiple criteria for a stop loss. It could be not getting to my target quick enough, going down $2 and then not being able to bounce, et cetera, et cetera. It can be whatever you want. That's how you discover what works for you. But I'll tell you right now, one of your stop losses had to be on Apple coming into the week, getting out on a break below 650, because that was clearly key support from October 2nd. That was a key low. Okay. Excuse me. So you can see the move, once it cracked 650, ran all the way down to 623. Yes, it has recovered, but still we now had 3 days go by, and even though these options have until November 17th, you can still see the toll that the time has on these options. So the other thing I want to point out about today and over the last week or so, and again this has to do with time, is even though Apple rose today, many of the premiums did not rise. What do I mean? Well, take the 650 strike calls, for example, in Apple. These calls closed at $2 today. So the 650 strike calls, again, what that says is you're paying for the right to own Apple at $650. All right? So even though Apple was up today, it wasn't up enough to instill to the market a good amount of certainty that it will be above 650 come this Friday, the expiration date. Therefore, you're not seeing the premium rise in value. We're learning more about Apple each day, and although it had a decent day today, only a 3-point move, it needed a much bigger move in order for the premiums here to be effective. Why? Because again, a whole day went by and it's looking like Apple won't be above 650. So you're starting to see this premium decline. And much like the other premiums we've discussed, it's been declining over the last few days. This was at $7 coming into, this was above $7 on Monday, and now it's down to $2. Okay? So the 620s, on the other hand, the right to own Apple at 620 was up 3 points today, or roughly 16%. Why? Because this premium was more closely mirrored to the actual price in Apple. What do I mean by that? Well, notice it was a higher price because it's at $21 versus this one at $2. Excuse me, $21.50. Previously closing at $17.90. And you can see that Apple closed yesterday around 636, 635, 636 level. So you weren't paying a significantly greater amount for the option than you were for the stock itself. because we've talked about calculating break-even in other videos before, which I will link in. Here, your break-even was $637.90 coming into today, whereas here it was $652.50. So in order for the 650s to have seen a significant rise, they really would have needed Apple to rally towards 645, push up towards that 640 high level. Okay. Whereas the 620s, now that Apple rose up to 640, even though it wasn't a huge move, they were still able to better reflect a good amount of premium, a nice 16 to 18% rise. Now, this is good because it shows you what can happen to premiums when the value of the underlying asset falls. Remember, we used that example with the new Tesla car coming out, and how if it receives negative press or positive press or neutral press. Well, Apple, over the last week in terms of stock price, the stock price going down is the equivalent to the Tesla receiving negative press. That's the analogy we used last video. So this is good to see. Now, let's talk about being on the right side of premium. In one case, in an extreme situation. Here we have Yum Brands, YUM. It was trading at $65.70 yesterday. And look, you can see, unlike Apple, which over the last 100 days made a big move higher, Yum Brands has just kind of been channeling back and forth. Okay. The company reported earnings today, though, and it rose 8%, made a huge move higher. So, if you had been in the correct option, or in any call option early on Yum Brands coming into today, you saw a significant increase in value. So let's put some of this in perspective and again explain why what happened. So you can see, coming into today, the right to own Yum Brands at $70 by October 20th expiration, that's next Friday, was trading for 32 cents. Why is that? Well, it was at a low level because, again, like we discussed with Apple, a couple days had gone by, and just in general, the stock seemed to show good certainty that it would have a tough time being above 70 by that expiration. You can see that it's been struggling with this 68 level for some time. Really, the base of this gap down, which is interesting because we just talked about a gap down in Apple. So the base of this gap down from late May, early June, really what has been the struggle point for Yum. So premium 32 cents yesterday isn't a lot, but it made a huge move today. So now all of a sudden the right to own Yum Brands at $70, the price for that right is going to rise to keep in line to an extent with the rise in the underlying stock itself. Again, these are all things we talked about in our first video titled, "What do you actually own when you buy an option?" Now, you can see that today the 70 strike call opened at $1.34 and hit a high of $2.30. So with the stock moving 8%, you had the right to own that stock at $70, ran to $2.30 for a potential return of 618%. Okay. But keep in mind, this was with a catalyst. The company reported earnings after the close. So you need to be aware of company events, because imagine the person who had puts coming into today. They're down a ton. Okay. And earnings plays are when stocks can make a big move. So if you get caught on the right side, like anyone who had yum calls, it can yield a very nice return. This right to understand what you're owning is so important because it helps explain why the price of the premium is moving the way it is. The other thing to make sure you understand, which takes a lot of experience to get used to, is how 1 or 2 days can have a great impact on the price of the premium you own. Excuse me, on the premium of the option you own, the price of the premium on the option. Because like we pointed out with Apple, even though it's only made less than a 2% move, it did a lot of, went down to 620, came back up to 640, and even though it recovered all of yesterday's losses on the stock, the options haven't been able to recover it because time is going by. Time impacts premium the most. When something happens and at what time does it happen? The good side of that is when you catch a move like Yum Brands. And this hasn't been a good week for Apple, but on the on the call side, for many weeks, it offered great intraday moves. I'd bet if we look at, say, the 650 strike call in Apple expiring this month, we can see what was probably a nice move at one point before it has now declined. That's not what I want. I want the October. Oops. Yeah, so you can see here that from July 25th, the October 650, the October 20th expiration 650 call closed at $6. That was, on that day, Apple closed around 570-ish, I believe. Yeah, 575. And as Apple moved to an all-time high of $705, this call moved all the way to a high of $58, or an 860% return. Okay? However, now it's right back down to $8. It gave up all of those gains. And notice when the premium really started to come out. What do I mean by that term? When the premium really started to decline in value. So Apple hit its all-time high on September 21st. And On that gap down, Apple gap down September 21st from 700 down to 686. So that was a 2% gap down. Meanwhile, these calls gap down from 55 to 43, so a 20% gap down. And on the follow-through day, Apple then gapped down again, another 5 points, less than 1%. But these ended up finding themselves down, gapping down and declining all the way to $34. So in 2 days, they lost nearly 50% of their value. So it only took 2 days of time. It only took 2 days and a good healthy move lower in Apple to really cause the premium to come out of these calls. And you can see it's just absolutely eroded now, because as you got closer and closer to October 20th, the premium adjusted for the fact that Apple was no longer seeming as certain to be very high above 650. When Apple was at 700, it was easy to put a $50 premium on the right to own Apple at 650 because it's over $50 above 650. You can see now even they're still putting premium on it. But what will happen is, say Apple bounces up to 670 by the end of next week, you'll see these options rise back up towards $20. But if Apple just stays flat and it becomes more clear that it won't be above 650 by next week, by next Friday, then this premium will slowly drift all the way down to zero as it becomes worthless. So I thought this was a good video to show that reflects how options can move based on what the stock itself is doing. And for those of you who need to better understand something like calculating your break-even price, please go to our website and click the tab that says Trading University and click on videos, and there are lots of videos that talk about calculating your premium and the advantages and disadvantages of buying the November 17th 700 strike versus buying the October 12th 670 strike that we've talked about.